The current price of New Fortress Energy Inc., trading under the ticker NFE on the Nasdaq, is $1.18 USD. This represents a decline of minus 8.53% in today's trading session as of the market close on November 3, 2025 at 4 p.m. EST, with after-hours trading showing a notable pre-market uptick to $1.60 on the morning of November 4th, suggesting a potential gap-up open based on the latest momentum. The immediate observation isn't the daily drop itself, which is a common occurrence in volatile names, but the staggering context. This stock is down over 90% from its all-time high, sitting near its 52-week low of $1.17, and yet the market is rife with whispers of potential multi-bagger returns if just a few key projects break correctly. This tension between the expectation of a total loss, given the steep decline and massive debt load, and the reality of significant, highly material near-term operational catalysts is exactly what defines the NFE story right now. Most individual brokerage accounts, whether you're using a platform like Robinhood for quick trades or the comprehensive research tools on a Fidelity trading platform, likely look at the chart and see a falling knife. The general belief is that this company is struggling under a massive debt burden. Some reports place it around $9 billion and facing execution delays on complex custom-built energy projects. The fear is palpable, and the stock's move reflects the market's assessment that the risk of a financial restructuring or worst-case scenario is uncomfortably high. This expectation, however, is challenged by a deeper, more contrarian take that forces a second look. The current price level seems to embed an almost worst-case debt distress scenario, overlooking several significant tangible operational milestones that have recently been achieved or are imminent, and which could radically change the company's cash flow profile and creditworthiness. Let's look at the recent trading reality. The average trading volume is well over 13 million shares a day, signaling intense activity and a high level of speculative interest. Just in the last month, the stock has dropped over 45%, a staggering move that has likely flushed out a significant number of retail investors and smaller funds. But institutional activity, which often provides the anchor in these highly volatile situations, shows a fascinating mixed picture. Recent 13F filings, though somewhat lagged, showed institutions collectively increasing their long positions in the prior quarter, even as the price dropped, with notable names like BlackRock and Vanguard increasing their share counts. This suggests that while the overall market sentiment is negative, larger professional investors are seeing an opportunity in the deep discount, essentially placing a bet on a successful turnaround and asset monetization strategy. The sheer volatility, with a 52-week range of $1.17 to $16.66, is a sign that this is no ordinary stock. It's a high-stakes play on global energy infrastructure execution. The latest market-moving news centers on two areas: project execution and financial maneuvering. Operationally, the company announced it achieved first fire at its 624-megawatt Celba 2 power plant in northern Brazil, a major step toward commercial operation. This isn't just a tiny incremental step. This is a physical de-risking event for a project that is designed to generate significant, long-term contracted cash flow. Furthermore, they secured a milestone agreement for long-term gas supply with the Puerto Rican government, a contract that some analysts speculate could be worth up to $20 billion over its life. These aren't abstract concepts. These are literal, tangible assets coming online and securing long-term revenues. The expectation is that the debt is too large to handle. The reality is that the new contracted cash flow from these facilities could be the specific factor that addresses the debt concerns. Investors who utilize intelligent portfolio strategies or who practice online investing must weigh the guaranteed long-term nature of these energy contracts against the immediacy of debt maturity schedules. The short-term movement, the minus 8.53% drop we saw at the close, is likely a combination of continued selling pressure from investors who are simply capitulating on the massive year-to-date loss and short sellers maintaining their pressure in the absence of a definitive, positive financial restructuring announcement. The company's core business model is a vertically integrated structure, focusing on liquefied natural gas supply and power generation, primarily targeting underserved and emerging markets. Unlike traditional energy companies, NFE builds the entire value chain: liquefaction, shipping logistics using floating storage and regasification units, FSRUs, and the power plants themselves. Their goal is to rapidly deploy fully integrated turnkey energy solutions. This fast-to-market model, which they term Fast LNG, is their differentiation, allowing them to sign long-term power purchase agreements, PPAs, with governments and utilities like Jamaica, Puerto Rico, and Brazil, where reliable, cleaner-burning natural gas is a massive upgrade over older, dirtier fuels. Older reports confirm the strategy. NFE focuses on the speed of deployment and securing those long-dated stable cash flow agreements. The past performance narrative, however, is a textbook example of capital-intensive execution risk. They took on a tremendous amount of debt to build these projects simultaneously, and when there were construction delays, cost overruns, and supply chain issues, that debt quickly became a major headwind, leading to the catastrophic price depreciation over the last year. This is why the stock is sitting at this current valuation. The old reality of execution risk has severely discounted the future expectation of cash flow. Now, let's talk about the future outlook, where the expectation versus reality dynamic gets intensely sharp. The immediate catalyst is the impending Q3 earnings release, which is expected very soon. But even more crucial is the update on the financial front. Recent news, as unsettling as it sounds, about the company considering debt restructuring via a UK scheme of arrangement rather than a US Chapter 11 is a key piece of information. The market expects a Chapter 11, which often wipes out equity holders. The reality is that a UK scheme of arrangement can be a much more flexible process designed to keep the company operational and can potentially leave some value for existing shareholders. This management's background is deeply rooted in complex private equity and financial engineering, giving them expertise in navigating distressed situations that a typical utility management team might lack. This is a subtle but critical distinction. The key to the stock's future hinges on the successful completion of the CELBA 2 plant, the continued positive momentum on the Puerto Rico contracts, and the successful financial management of their looming debt maturities. If they can sell or monetize an asset, like a non-core terminal or a piece of their shipping fleet, it could provide the liquidity needed to bridge the gap and avoid a more severe debt scenario. This is a game of high-magnitude outcomes. If the Puerto Rico deal fully materializes and the Brazil plants achieve commercial operations smoothly, the fixed contracted revenue base could be several multiples of the current market capitalization, causing a sharp, rapid reassessment of the stock's value. The potential upside is significant, but it requires a stomach for massive risk. Conversely, if the debt restructuring falters or the project delays continue, the downside remains a total loss of principal, which is why the stock trades at its current discounted price. This is the difference between speculating and truly investing online with eyes wide open to the risks and rewards. It's a binary bet on financial engineering meeting complex energy infrastructure execution. For those managing their own capital through a platform like SoFi Invest or using a traditional individual brokerage like Interactive Brokers, this is a position that requires constant monitoring of the news wire, not just the technical chart. The story of NFE is one of extreme contrast, a vision for rapid, cleaner energy deployment in developing markets, but funded with a highly aggressive capital structure that has brought it to the brink. The market is pricing in the risk of the latter, while largely ignoring the potential value of the former. The ultimate reality is that the massive infrastructure they have built is real, operational, and contracted, but the cost to build it has put the firm in a precarious position. The expectation of a total loss remains high because of the debt, but the recent operational successes in Brazil and Puerto Rico provide a concrete, measurable path out. These projects are the company's lifeline. Comment below, tell me, do you think the new long-term contracted cash flow from the Brazil and Puerto Rico projects will be enough to successfully manage the debt, or is the $9 billion burden simply too heavy for New Fortress Energy to overcome? This stock is a perfect example of why you can't rely solely on the headline price action. You need to understand the underlying financial engineering and operational execution, the real business model, to appreciate the massive leverage, both positive and negative, that drives a price like this. The coming weeks, leading up to and immediately following their earnings call, will be some of the most telling in the company's history, as the market forces a resolution to the tension between its massive debt load and its burgeoning asset base.